one of the reasons I avoided real estate for so long, and I thought it sounded too good to be true. It sounded like there's kind of some slimy sales marketing out there for real estate. And the other thing was the whole dogma of like real estate goes up by about 3% per year, but the stock market might have historically gone up by around 9.5% per year. So of course, why would I do that? But then when I learned about leverage, I was like, oh, now I'm getting in with a small chunk of the pie, but I'm able to leverage the entire value of the property. And that was one of those epiphanies that kind of blew that up for me. And that is when I really started to appreciate real estate.
Hey, Colorado. Today's podcast, I have a very exciting guest in the podcast studio. So as you know, I love talking real estate investing strategy, and I've had a couple of financial planners on and off the podcast over the years. And this one today, Mr. Daniel Huffman, is what I'm most excited about to have in the hot seat because he's a financial planner that specializes in real estate investing. Not, oh, he does it, knows about real estate investing, but no, he actually practices in real estate investing. And we connected at BPCon last year.
Yep.
It happens to be down in Colorado Springs as well, and we've had a great relationship. We have had some friendly debates and discussions, but I want to bring him in here today because he has a very unique view for about comprehensive financial planning, everything from stocks and bonds, insurance, to also real estate investing. So Daniel, great to have in the podcast studio today.
Yeah, thanks for having me, Chris. I'm excited to be here.
I am too. So you are with Cornerstone Financial Planning, and we're going to talk about your story, and we're going to spend a lot of time talking about how to structure a portfolio. But I know first we have to go through a disclaimer. Give us your disclaimer since you're a licensed professional.
Yeah, so I am licensed in the state of Colorado, so I'm not soliciting from any jurisdiction I shouldn't be. This is all for educational and informational purposes only. And as always, if you need to make a financial decision, talk to your own financial, legal, or tax advisor.
Great. All right, now we move on to the fun stuff, Daniel. So how the heck did you become a financial planner that focuses on real estate? Because you are a very unique breed.
Yeah, so there are not many advisors who do focus on real estate. My journey started out a long time ago. I was active duty Army as a physical therapist, and I spent about 11 years on active duty doing that. And probably around 2014, 2015, I started to find the financial independence community. And I'd always been
like the fire.
Yeah, the fire community. Yep. And the funny thing is that I always resonated with financial independence, but never the retire early part. And so I always kind of struggled with that. And then real estate ended up becoming my RE. So that was my missing piece. But, to fast forward, I was in the fire community. And as I was learning a ton, and that was at the same point in life where my wife and we got married, we were dual income, no kids. And so we were making more money than we had made. And I just started learning more about investing in finances. Up until that point, I'd been pretty big, Dave Ramsey, stay out of debt. And I was very fortunate. I was one of those people that did that. And so as I was in the fire community, kept learning more and more. CFPs were the people, certified financial planners, that is, those were the people that I was learning the more complex and advanced strategies from. And so it just planted that seed like, hey, someday I would love to do that. And I think I'd be really passionate about it. Well, throughout my military career, typically on deployments, I started leading financial classes. We would go through Dave Ramsey's Financial Peace University class.
Were you teaching some of the Dave Ramsey classes?
Yeah, for sure. So I would teach those, but deployments are a lot longer than 9 weeks. So I just started making my own content, and then that morphed into a financial independence blog. And then it kind of morphed into what I call factor investing blog. And then in 2019, I kind of had that, epiphany, I guess, where crap hit the fan. And I was like, it's time to be out of the military. And so becoming a financial planner was actually that transition. So I guess I had enough of the financial independence Kool-Aid to where I was like, I'm just going to stop mid-career and do what I want to do now and then spend my time with it. So yeah, that was kind of the journey from active duty PT to financial planner. And then that's what led us to Colorado and real estate investing.
I love it. And it's so interesting that you were like a fire person first and then became a planner, because I feel like that's not a common journey whatsoever.
Yeah, it's really not. There's only a handful of financial advisors that I know that I would say really specialize in the financial independence kind of movement and the approach. Traditional financial advisors may work with people who are maybe late 50s into their 60s. they're retiring within 5 years typically, and they want to plan out maybe a 25 to 30 year retirement. I'd say that's more traditional. Us, on the other hand, in the FIRE community, we're focused on helping people retire maybe in their 40s or early 50s. So we're looking at like a potentially 40 to 50 year retirement horizon. Mm-hmm. And you have to plan differently. You have to invest differently. Healthcare is different. There's a lot more tax optimization that you can do the earlier you retire. And so, yeah, there's a lot of nuances that are just very different from traditional financial advice.
Yeah, until we were prepping for this podcast, I didn't know you were part of the FIRE community. I was active in it for, a little bit. This was probably a decade plus ago. There's a lot of big influencers online. I followed some of their blogs, and after a while, I personally just got bored with it because I was like, well, I don't want to save my way to success. I actually want to live modestly, but also I want to earn and invest my way to success, which is, I think FIRE is much more about saving and living extremely below your means. And I'm a big believer. I want to enjoy life today, and I like some luxuries today as well.
Yeah, for sure.
And the second thing is nothing was focused on real estate. It was all invest in S&P 500 index fund and plan for a 4% withdrawal one day. And it's I was like, well, there's more to it, and I want to get into real estate. So we have a lot of similarities on there as well. So you left active duty military in 2019.
2021, actually.
2021, okay.
Yep.
When did you become licensed? A financial planner license?
Yeah, so I left the military late 2021, immediately started the CFP program, finished it, passed the exam in July, and then it took me about 6 months to officially get my firm started and registered in Colorado. So I officially opened my firm's doors in February of 2023.
Great. All right, and so let's come in here and just kind of walk through an example. I want to get into building the comprehensive financial plan because, I debate this with myself. I debate this with clients. We all look at, most of my investors, and myself included, we own a lot of real estate. That's the majority of our net worth. But also, we like stocks. I own stocks. I own very few bonds, but mostly stocks. I'm a big believer in both asset classes. But when you start looking at that global portfolio, it's always, well, what do you balance? How do you make them non-correlated? How much you've allocated to here? And I'm so curious to pick your brain on here because other financial planners I've talked to, they maybe understand a little bit of real estate, but nowhere to my knowledge or your knowledge. So, we're real estate investors here. We come into you or someone comes to you with, their assets. How do you start planning? What do you do and how do you plan out their portfolio?
Yeah, it's a good question. The good advisor answer is it depends very greatly, right? That's the good answer there. You really always have to start with where people are because everyone comes with something and they come with some biases. And I have my own biases, so I'm always very clear on those. And I will just tell everyone, my bias is that stocks and real estate belong, I think, in most people's portfolios. And whether you're not a real estate investor, but you own a house, I count the house you own as an investment because there's tax optimization around that. There could be a great opportunity to use your house to launch you, and especially into Colorado. But owning a residence here for over 5 years, you probably have significant equity in it.
Yep.
So there could be opportunities for the Section 121 home sale exclusion, where you sell, well, you don't sell it yet, but you lived in the house as a primary owner and resident for over 2 years. And then you can move out, rent out your house for up to 3 more years, and then sell it and still get the gain tax free. Less what's called depreciation recapture, but that's usually pretty minimal.
Yep.
And so I always am trying to help people view their primary residence as an investment. So I kind of say almost everyone is a real estate investor, even if they don't know it yet. But that can be a great launching pad into a second property or a multifamily property.
So I wanted to ask you a question on here because I have the same discussion with some of my investors. Hey, live in this property, sell it, take $200,000 tax free off the table and go invest in something bigger and better, right?
Yep.
So one of the debates I have, I don't know if you've had this debate with your clients, but it's hey, they've lived there for at least 2 of the last 5 years. They can sell it and just get the cash today. Or if you hold on for a year or 2 or 3, you might capture some more appreciation. But there's also some risk on there for, a tenant not loving the property as much as you do, destroying it. It's a very low risk, but I've experienced that with my properties. A tenant will eventually destroy a property.
Yep.
Or some of my clients. How do you balance that risk? Or is that something where it's hey, we're talking so much appreciation that, hey, if we have to do a $30,000 remodel. It's a small risk, but still makes sense financially.
Yeah, you always have to have a contingency plan for that. So part of the comprehensive financial planning would be cash flow management and then making sure you have enough liquid reserves on hand to cover something like that. Now, hopefully, while we've all experienced that, hopefully that's still a more rare occurrence. And, depending on the type of property you had, hopefully you can command a good tenant with good credit, that will be a good renter. And so, but that risk does always exist, right?
Yeah.
So that's kind of into someone's risk tolerance or risk capacity for doing that. So that's where I think comprehensively, if that doesn't work for people, that might be where something more passive like syndications or some type of fund could be a better real estate investment for people.
And to just jump in here, I mean, one of the things I respect about you is you own rentals yourself. I know you've invested in a few syndications. So like you understand the direct ownership rental game. You understand the syndication passive game. And one is not better than the other. They're both amazing ways to get access to real estate.
Yeah, for sure.
Who is your typical client? Are they in their 40s and 50s with a lot of real estate? I'm just going to paint who's your typical clients we're talking about this holistic portfolio approach?
Yeah, so I really have two main groups of clients, I would say. My first group of clients is people who want to get into real estate and they don't feel comfortable with the finances or the financial analysis. So I'm pretty good at underwriting and then helping people frame kind of how we underwrite a property. And this is, what I liked about you when I first heard you on a podcast, but talking about return on equity. And then I add a time component. So I focus on the IRR, the internal rate of return, a lot. And so just helping clients underwrite a property, we kind of do like a worst case, more realistic, and then kind of a best case scenario, compare the IRRs over various hold times. And then I always show them too to, watch where does the IRR peak if you sell it at, 3 years versus 5 versus 10 or 20. And typically there's some deterioration of the IRR over time.
Oh yeah.
And so, so that's where that's what I love about what Property Llama does, even though we are not formally affiliated. I do love what you guys do, and you provide opportunities for people to 1031 into potentially better performing investments. So I talk a lot to people about opportunity costs. I think a lot of real estate investors, they love and they romanticize that idea of I'm going to buy this property and hold it till the day I die. My kids will inherit it, stepped up basis, tax free. And it's like, that is great. That is a really massive benefit that we have, right? But for a residential property, after 27 and a half years, depreciation stops. So a big chunk of tax benefits stop. Also, again, if you look at that IRR, typically cash flow goes up, but your equity eventually goes so high that your return on equity is super low and your IRR therefore also drops. So there typically is like a peak on the curve. And so trying to help clients visualize upfront, if we underwrote this property well, we would expect this type of return over X number of years. And then I say the IRR is a nice apples to apples comparison. Yep. Does that compare to what you might expect in the stock market? Because a lot of people will look at real estate and they don't expect their IRR to drop so much, but it might end up being like 5 to 7% or something the longer they hold. It's like, why would you take that risk of the tenant destroying your property or the risk of, whatever it is, insurance going up so massively like it has the past few years? Why would you take that risk and the risk of getting sued when you could just invest more passively in stock market?
Yeah. So do you, I know this is not the proper phrase to use, but I look at the stock market as my quote unquote risk-free rate of return.
Okay.
And I know it's not treasuries are more like the true risk-free rate of return. I look at stocks because I'm very bullish on stocks in the long run. Mm-hmm. And also for me, it's I can't get sued. There's going to be no capital calls, no I have to come do anything. It's if I can just put my money there and I can handle the stock market roller coaster. We're recording this early April and there's been the cliff the last few days with the tariffs being announced. I have no problem riding that. And so I kind of classify that as my risk rate of return. And if I can't have a real estate asset outperform the stock market, I have to have a really good reason to not just be investing in the stock market, which is passive and no complaints, no lawsuits.
Yeah, for sure. And, just to go back on my story again, I mentioned coming from the Dave Ramsey world. So I was really big on being debt free. And one of the reasons I avoided real estate for so long was, one, I thought it sounded too good to be true. It sounded, like there's kind of some slimy sales marketing out there for real estate. And the other thing was the whole dogma of like a real estate goes up by about 3% per year, but the stock market might have historically gone up by around 9.5% per year. So of course, why would I do that? But then when I learned about leverage, I was like, oh, now I'm getting in with a small chunk of the pie, but I'm able to leverage the entire value of the property. And that was one of those epiphanies that kind of blew that up for me. And that is when I really started to appreciate real estate. So yeah, I had to come out of that debt-free mindset. And then also just realizing, a paid off property, typically it can give you the highest cash flow immediately, but that is typically where that return on equity may drop.
Yep.
And so there are trade-offs, but it's also, I'll caveat that by saying there's a time and a place to take risk off the table. So I do like for some people, if they want a paid off property and their return is, 6 to 8%, that might be perfect for them, almost like an annuity in some ways.
Yep.
Not that they are the same.
Yeah, but if it achieves your goals, I agree with you. Like if it achieves your goals and it fits your risk profile, great investment then, right?
Yep.
But there's so many factors in there.
Yeah.
All right.
For sure.
So looking at the portfolio here, you have a lot of real estate investors, myself included. And before we get more into real estate, what's your like high level theory and planning for stocks and bonds? For myself, I got 70% of my net worth in real estate, 30% in the stock market. What do you generally how do you like recommend or advise people to allocate in the stock and bond market?
Yeah. So again, it really depends on their goals and their risk appetite. Now, I do view risk very differently than I think the traditional financial industry would. Typically they talk about risk tolerance and they give people a questionnaire and then they get a score and then they invest them in some corresponding asset allocation of stocks to bonds and cash that just seems to have been accepted over the decades, right?
Like the 70-30, 60-40
Yeah,
type
exactly.
split.
Yep. And so I don't agree with that. I don't think that's the right way to do it. I also think that some of those risk tolerance questionnaires, they have questions on there about gambling. And so what kills me is that a high score on a risk tolerance questionnaire is actually like a gambler. And kind of that moderate score or upper, we'll say slightly above average, to me, that's where you actually would score if you're a competent investor. And so I feel like those people actually have the best risk tolerance and capacity to then invest in real estate and stocks. So to answer your question, I look more at risk capacity and like financial need and versus like financial risk rather than the risk tolerance as on the questionnaire.
What exactly is risk capacity?
So risk capacity would be defined more as your ability to absorb a loss or to absorb a risk. So for some clients, say they have $30,000 and they want to start investing in real estate. They might have a high risk tolerance because they're willing to risk all 30. They have a very low risk capacity. And so if we were
because they have no reserves or
right,
no contingency.
Right.
Okay.
No reserves. Maybe they can offset that with a high income. Then job stability comes into play, So a lot of people in the tech space might have had high incomes and a high risk capacity for a minute. And then if they didn't have the reserves that go with that, then they are now probably hurting in some areas. And so I definitely look at risk capacity a lot. And then kind of what people's need to take risk is to achieve their goals. And again, with financial independence community, we're a lot younger. And so we have a lot longer time horizon. So I think we, in some ways, need to be more aggressive. So all of that to say, because of how bonds are and because of how they are sensitive to interest rate changes, and because, in 2022, when bonds dropped around 10%, we'll say, across the board, I think a very long bond bull market ended. And so a lot of our past performance on bonds was driven up by the high return of falling interest rates from like the 70s on. And so I'm not such a big fan of bonds for the temporary time being. Now, that said, this is not financial advice. This is not investment advice. But what I'm saying is that I think people who hold bonds need to realize that bonds may not be the safe investment they think they are. They are not a great hedge against inflation. They are, again, highly sensitive to interest rates. Meanwhile, real estate, especially if it's a paid off rental property, I kind of view those as like a high quality bond, a high yield bond, because you have the asset that backs it. Real estate is good for inflation. In fact, inflation is what drives real estate. And hopefully there's always a little positive return above the inflation rate
Hopefully.
Yeah,
yes.
especially here in Colorado, but other places, and I work with investors from, all over in the states I'm able to, but yeah, it hasn't been the same, as what we've experienced in Colorado. And so when it comes to that overall asset allocation, one, all that stuff I just said about risk, kind of put all that together. And then that, to me, on the real estate side, determines leverage, or how much leverage they could take or want or need to take. And then on the stock and bond and cash side, we'll say also how much, if any, do we need bonds. So again, not investment advice, right? But right now I'm really preferring money market accounts or high yield savings accounts because they're yielding about the same as bonds, but without the risk.
Yeah.
And so why take that risk? Plus, a good high yield savings account is FDIC insured, where bonds are not. And so, I want to take risk where the risk is calculated and I expect a positive return. I don't want to take risk where there's not an expected positive return over the long term.
So I'm going to use myself as an example. So like I said, I actually turned 43 in a couple of days. So I'm, early 40s, and I have a high risk tolerance, not the gambling type, but I can handle volatility.
Competent investor.
And competent. Also, I learned from, a previous business in real estate that I had during the great financial crisis. I ran out of cash for a little bit, which stunk. And I learned as an entrepreneur investor, keep like a year's plus type of cash in savings accounts and, very liquid stuff just for like when something hits the fan. Running out of money is kind of like key number one. So I learned that. So I have a high risk competence, I think is what you call it.
Capacity.
Right? Capacity.
Yep.
So with that in mind, is that 100% equities usually, or like a 90? I'm a big fan, and maybe you can't say it for that, but I'm a big fan of like Warren Buffett's. I do 90%-ish, S&P type index funds, 10% in a lot of like T-bills and cash, very short-term safe stuff. Do you have any like allocations you usually go to, or is that an area you can't talk about on a podcast?
Yeah, I'll be careful answering that. What I'll say is, again, I'm very aggressive and I'm not a fan of bonds for what they do. And I will say right now, bonds have actually been a hedge to what's happened. At least some bonds have. And so I think when it comes to that type of asset allocation, I am definitely big on the same type of investment philosophy. So I'm a big fan of building a diversified portfolio of stock index funds or ETFs that track certain sectors or segments of the stock market. We discussed this just a little bit, but, again, just a disclaimer, educate yourself on this. And this is not advice for everyone to just implement, but I believe in what's called a factor investing strategy, which is further diversification within the stock side. And so you can actually build a pretty diversified factor portfolio that really represents the entire US stock market. But one of the keys is in different weights and then with different tilts towards different factors or styles of investing. Warren Buffett's the best known value investor. Peter Lynch might be another good name. And so those guys were investing in value stocks. So value is one of those factors. We also know, looking back at Warren Buffett, in fact, there's a cool paper called Explaining Buffett's Alpha. And it basically just goes back in history and it looks at from Warren Buffett from inception to now. With what we have available today with like small cap value index funds, you could basically replicate Buffett's return by just investing in that. Now, the problem is that's not a guarantee of the future, right? So will small cap value continue to do as well the next 60 years as it would have Buffett's last 60 years? Who knows?
So a lot of his success came from small caps?
Yep.
Okay.
Yep.
Value investing in small cap funds or small cap businesses?
Yep.
Okay. So one thing, you said, I'm a index fund believer. I'll buy one or two stocks here and there with my play money, but I'm like 99% index funds. One of my issues or considerations, you look at like an SP 500, look at like QQQ, look at all these, is like the top 20% holdings are all the same 5 or 10 stocks.
Right.
So how do I achieve diversification beyond that?
Yeah, so this is a huge debate, especially in the financial independence community. There's kind of the VTSAX and chill crowd, which is the Vanguard total US stock market, investment or index ETF or fund. And then the ETF is VTI. But there's the people who believe just own the whole market and sit back and chill.
Yep.
My problem with that approach is that you do own the entire market in their market cap weight. So yeah, the top like 7 to 10 holdings of that fund, last I checked, which has been a little while, but it's like 20% of the entire fund.
Like the Mag 7?
Right. Yeah. And so if you look at how diversified you are, there's about 10 stocks that drive our entire market. So what I recommend is diversification by segment of the stock market. So large cap, mid cap, small cap. And then so you kind of slice it horizontally that way. And then again, the factor strategy would be maybe more like vertical slicings of the stock market and then tilting towards.
What do you mean vertical slicings?
I have this,
like different sectors, like financial or tech?
No. So that's where I'm talking more about the factors.
Okay.
So the validated factors in the research are size, value, profitability, investment, and momentum. So stocks that demonstrate those characteristics, and then I'll add one too that's kind of a combination of a couple of those, and it's called quality. So stocks that have those characteristics that can be empirically, shown that like this stock is high on value, this stock is high on quality, this stock is low on investment is actually the good one there. And so if you have stocks that meet those criteria, they have indices now that track all those. And so then there's some fund companies that develop, again, ETFs or index type funds. A lot of them I say are index based. They might loosely follow like the S&P 600 for small cap stocks,
okay,
but then they only include the stocks that are high in quality in that, or they might only include the stocks that are value in that. And so there's kind of different flavors of all of this. And then different fund providers or fund companies have all come up with their own little, I don't know what to call it, but like their own little twists and, cute things that they do with them. And so to go back to the total market comparison, I believe you're more diversified if you build a portfolio that is spread out among, the large cap, the mid cap, and the small cap. And then if you diversify further by factor, research would show that returns over the long term are better if you do that. But also you're getting a lower correlation between those. So actually last night I was looking at the S&P 500. The S&P's down for this year, right? If you separate out the growth portion of the S&P 500 from the value portion, the value S&P stocks are up about 2% this year, and the growth stocks are down about 9% this year. So roughly an 11-point delta on that. And that is why certain stocks behave differently at certain times. The problem with the S&P 500 as an entire index is that it's driven by growth stocks. And so those are the big ones at the top. So some stocks are actually up, not all of them. So yeah, if you only hold one fund like that, you're protected from what I'd consider a total loss. And I always tell people, unless maybe another country invades and we end up speaking their language, then we'd have a total loss. But
yeah, if the stock market goes to zero, we got bigger problems than retirement accounts.
Exactly.
I'm going to your bunker in the mountains then, right?
Yeah, exactly. Wait, do you know the way? We just watched Paradise, and that has me thinking.
Oh, really?
Yeah, it's a show about a bunker in the mountains here in Colorado. So
I don't know that show, but maybe it's foreshadowing some stuff, huh?
Yeah, hopefully not.
So it sounds like you're a big believer of just a basket of index funds, ETFs, that are not as correlated through this factor investing, as you call it, right?
Yeah. I would say that's
Do you
good.
mind say like how many in your portfolio table clients? Is it like 5 or 10 ETFs or index funds? Kind of what's the general like basket count?
I would say the general count is roughly 10.
Okay.
I would say that I can probably take things too far. I think if you had to, I think 3 or 4 would be sufficient. I think you can get probably 90% of the exposure from 3 or 4 funds. I like to be a little more specific, and I like for some opportunities to rebalance or to tax loss harvest from one to the other. Mm-hmm. If there's 2 similar, small cap funds that I'm holding and I want to move from one, I can just move into the other one.
That makes sense.
Yeah. And so, there's a fine line between unnecessary complexity and maybe over diversification, which has been termed diversification. So I always like to keep that in mind. I mean, I'll see some clients come to me with portfolios that have like 28 mutual fund and index funds, and then like another 70 single stocks or something. And, if I take the time to add that all up and put it into a software program that can get the total return, it's usually fairly low. They're taking a lot of risk with single positions. They're diversifying that risk, I think, way too far. So the diversification part with all those mutual funds with higher fees, and then their net return really, it doesn't seem to be that awesome. Having said that, some advisors swear by that. That's the strategy at some places. And I'm positive there's also been times where that's been much better than my strategy, But I think over the long term, for a buy and hold investor who doesn't want to manage things, that's where I definitely just recommend building a diversified portfolio of ETFs.
Okay.
That either closely or exactly tracks an index.
That makes sense. All right, I got kind of a random question here for you, and one we not prep for, but I'm curious in the diversification, all this, how does like precious metals, how does crypto, what type of weight or allocation does that get in your factor investing? Or is it depends?
Well, I will say there's not a factor for any of that. I think Warren Buffett said it best when he said to only buy as much gold as you can carry. So that's kind of my thing. I do have one client that I love, and he has physical gold, and I think he's even buried some of it. So I'm kind of nervous about that. So
he's very prepared then.
Yeah, huh? For something.
Yes.
But you can't fight people with gold bars.
All right. So you're not a big fan of precious metals and crypto?
Well, so I'm not in a general sense. So where I do like some of those holdings is more in what's called a risk parity portfolio. So
parity portfolio.
Yeah.
Okay.
So the portfolio I just described, that's one that I would say is aimed at optimizing growth over a long period of time. A risk parity approach is more, if you want to think about, I don't want to say hedge fund in the sense that like I'm building little mini hedge funds for people, but it's more at protecting downside. And so you do hold some of those assets. And so whether it's like, maybe gold or crypto or commodities or even utility sector. I'm blanking on another one that I typically think of. But if you're really trying to protect downside, holding those funds in a portfolio with some of the other types of funds that I was talking about, then you can kind of offset some of the losses. The challenge is you may also lose on some of the gains when the market goes on like a 10-year bull run, like it did from 2010 to 2020. So, but if protecting your downside is more important than growth, then those other holdings I think have a place. Typically, it would be a smaller place.
Yeah.
And, with crypto too, there's some pretty cool research. And if you think about an asymmetric bet, you can put, if crypto does what people think it will do, a very small allocation to crypto could be all you need to, boost your portfolio's return. So you don't have to take massive risk in a lot of these to get, hopefully, the decent return you hope to get. But yeah, from more of a risk parity perspective or, again, protecting your downside at the worst times, that's when I do think those could have a place. But okay. I do not build those into standard portfolios.
Okay, that's if someone asks about it or really has the desire to have that exposure.
Yeah, and if they really want to cover their downside and they want maybe higher growth than what we would expect bonds to provide, or maybe even what we might expect real estate to provide, if they're not going to be into syndications or something, then maybe we would talk about that a little bit more.
So I went through. I very much share a lot of your philosophies here, and I'm heavily weighted towards equities and really have, like I said, no long-term bond exposure. I have some short-term bills and things like that, but bonds for years I don't have in my portfolio. But like a year or two ago, I went through the mindset shift and actually started allocating a very small portion of my retirement accounts into crypto. So I was like, I'd rather take the chance on Bitcoin for the next 20 years than a 10-year bond for 20 years. And, I obviously know crypto is not the same as a bond, but I was like, well, I'd rather have that allocation for, they're not correlated. And also, I think there's just a lot more upside in crypto than holding bonds. Again, I am like very low single digits crypto. I want to be very clear. Like I am very, very conservative on there.
Yep.
But I went through a mindset like I'd rather own crypto for the long term versus bonds. And 5 years ago, I would have thought this Chris Lopez was crazy. But after the market changes, I was like, man, that just seems like make more sense to me that way. But that is my internal conversation. I'm curious if you think there's legitimacy to that, or if that's a crazy thought.
Sure.
Sure.
Yeah. Again, I think I think if you're going to allocate something to an asset class like that, I do think that small amount makes sense, because the theory and what a lot of like the crypto bros or that community,
Yes.
would believe, they believe it's going to be massive. It has been pretty large for a lot, especially like Bitcoin is the
Bitcoin's
big crypto,
crazy.
right? Yeah. And so if we had all allocated like 1% to Bitcoin 10 years ago, we'd probably be having this conversation on a beach or something, But yeah, there's a risk. The one thing I always remember with crypto, and just when I start to think it sounds too good to be true, the internal value of crypto is zero. And that's Warren Buffett's big issue. His partner, Charlie Munger, said a lot of bad things about crypto. And they're not wrong. At the same time, there is something there. And that's the difference between like gold and Bitcoin. Gold has a value, could be used in an industry, useful jewelry, obviously, but crypto you can't use for anything else other than trading right now.
As long as other people believe it has value, that's what matters.
That's true.
That was my issue for years. I was like, there's no intrinsic value. And that's why I never invested. And after I was like, wow, okay, this is around to stay. And maybe a little bit of FOMO as well, seeing the Bitcoin go up, I don't know, 300x since 10 years ago or whatever it was. All right. So before we move on to real estate, any other kind of like thoughts or comments you want to close loop on for stocks and bonds before we flip over to real estate?
I feel like I said a lot. Again, I would say that this is not personalized investment advice for anyone, but I definitely think if you're into this type of stuff, there's some really great books to read. So I recommend Larry Swedroe has a really good book on factor investing. There's also good asset allocation books by All About Asset Allocation is a really good book.
Oh, it's called All About Asset Allocation?
Yeah, by Rick Ferry. There, I was blanking on his name. And those are two really good books. And then Vanguard, the Bogleheads, they have a good book on the Bogleheads Guide to Investing.
Yep.
I think those are three great resources to kind of get started and build that diversified portfolio of index funds or ETFs that track indices.
Great. All right, now let's shift gears here and talk about the real estate side of the portfolio.
Mm-hmm.
Now, I know real estate's a lot more inefficient. A lot more, it's not public deals usually. Where do you even start with someone? Or does it all just depend on if they have current real estate or what their risk tolerance is? Like, where do you start with someone that comes to like real estate planning?
Yeah. So I think I was starting to say this earlier. I kind of have two main groups of clients. There's those that want to get started in real estate. And so they require a lot of the financial education and, the real estate education and strategy. And so they are more like, how do we do our first deal? For some of them, they have the capital to be able to take down a property. And so we work on underwriting properties. Others, it might be like a fix and flip. And maybe they are only 30 to 50K into a deal before they do that. And then there's the other ones who come in and they have a rental, but maybe they were an accidental landlord and then it worked out. So then we talk a lot about like optimizing it. So I'd say there's not one set way for that group. And then the second group is people who come with like a handful of rentals and they're like, we have these, they're doing something. We're not sure if we're doing well or bad. And we just want to make sure things are optimized. And so that's kind of the other group then. And that's more like portfolio analysis.
Okay.
And that's where I think like the Property Llama software, again, kudos to you guys for making that, but that can be so helpful for people to see how their property is actually performing. Yeah. So,
all right. So coming in with I'm asking this question because it's where I'm at, and also all of our listeners too, more and more in that second, like the advanced, right?
Yep.
We have some capital, we have some properties, we have some experience, got some black eyes as well with real estate investing, right?
Yeah.
What's like when you look at someone's portfolio, are most people like trying to get a certain cash flow number from their rental portfolio, or is it net worth? Like, what are they using in terms of like the metrics, their financial metrics when it comes to their real estate portion of their portfolio?
Yeah, so it is typically cash flow. Yeah. And so they're looking at, a lot of them look at gross cash flow, and then we try to look at like after-tax cash flow, see what they truly made on it. And so, yeah, just looking at that through a spreadsheet and like, what did you actually net this year? And that's after depreciation too. So after tax, what did you net? and then trying to help them see like the cash flow is awesome. So I've heard it said cash flow helps you retire today, appreciation keeps you retired. And I really like that because you need both. And that's, again, you call it return on equity, and I call it return on equity too. But what I really call it, whether it's stocks or real estate, is a total return approach. Mm-hmm. And so I want to make sure that with cash flow plus appreciation, my return on equity is not too low, and that IRR, if we factor in a hypothetical future sale at some date, that IRR looks strong. Now, sometimes I wrestle for myself with having an IRR that's lower than what I'd expect the stock market to do long term. But for other people, if they need more stability, then we might be okay with an return on equity or IRR that's a little bit, say, lower than stocks, but higher than bonds.
Yep.
And so I kind of want that like a high yield bond type approach out of real estate. But it really depends on people's phase of life. So early retirees tend to want cash flow. And then I love real estate because they're also still building that appreciation. And then it's more of a game of at what point does that IRR perhaps tend to dip? Is there anything at that point you can do to optimize a property, like renovate it? So one client I was working with, he had a couple properties he had owned. I think one he owned for maybe 21 years. And then another one he owned for maybe 14 or 15 years. And so his return on equity is around like 3 to 5% for those two properties. But we looked at it and comparing his current rents to market rents or above market rents, and then the cost of a renovation, I think he spent a total of $90,000 renovating those two properties. But we got his return on equity up to around 7 to 8.5% for those two properties. Yeah. And one of those properties too, I should caveat, is paid off. And so it's, a true cash on cash type return almost equals, it's like the cap rate because it's paid for in cash, right?
Yep.
And so that's a consideration, but his phase of life is early retirement and he has a family of 6. And so cash flow is pretty important. He's also in what we would think is a highly appreciating market. And so even with that though, I will say one of the mistakes I think I see people in real estate make a lot, especially in Colorado, is the whole mantra like real estate always just goes up. Well, inflation also always goes up. And so usually, and I'll just share, this guy's in California. And so his real return of his appreciation on the property above inflation was like 0.6 and like 0.8% for those two properties. And so we might think like, oh, California, and this is Northern California. I will say not San Francisco, but still Northern. We might think it'd be killing it, but it's really not. Like it just barely beat inflation, like a high yield savings account after inflation. So I do think it's so important for real estate investors, especially in states like Colorado with high appreciation. I think we can get lazy and think like, oh, it's going up. Maybe Zillow keeps going up, but you really got to look at inflation and then what your return is after that, and then after taxes. So that's where I think that more advanced group of real estate investors, really seeing what that return is, I think that matters a lot.
Yeah, seeing like the real return. And I agree about inflation. And then something that, I've been focused on personally and, talking to clients is, especially in the last, 15 years, the law of averages always kicks in.
Yep.
Colorado's been 5-6% appreciation historically.
Yep.
Well, through a lot of the 2010s, we were, 7, 8, 9, 10 plus appreciation a year.
Yep.
Eventually, law of averages kicks in, and that's going to be the other side of the coin, which is below that for the appreciation. Yep. And I think that's also kind of like the phase we're in right now. Of course, different asset classes are performing better than others. Houses are doing much better than condos are right now, for example. But I would add on there also like the law of averages. And because does real estate go up 3% every year? No. Some years it's more, some years it's less. Most years it's positive, but you will have some years that are negative. And also you will have some years that are just, hey, if you have great years of double digit, you're going to have some years of single digit or negative digits as well.
And I think we're probably a good example of that because we bought our house in 2021. And so we bought high, I know, and then the market did go down, and I don't even know what our house is truly worth at this point. I like to think we're ahead, but that might be because we finished the basement and built a deck. I don't know, so yeah, no, it's very, very true. One of the things I think with real estate, which may be a little less applicable to those with a good mature portfolio right now, but real estate did so well for so long And then a lot of people kind of jumped on at the end of the roller coaster ride, and it's been a lot harder to cash flow. It's been a lot harder to get appreciation. And so, yeah, I've seen some of the older real estate investors with like great portfolios that rode that wave really well. You know, those tend to be the ones that are like, just buy and hold because it worked out so great. The young ones who are over leveraging stuff just to get in the game, that's where I feel like there's a lot of risk. Yeah.
So when you're looking at optimizing people's portfolios, do you do much with DSTs, Delaware Statutory Trust?
So not yet. I've had a couple people who that would be an appropriate option for. I do love them as an option.
Why?
So, you know, kind of the best advice I've ever heard, I think, on it is anytime you do a 1031, using a DST as kind of a last resort, just to make sure you kind of cover your butt in case something would fall through with the real properties. But they tend to be expensive. So I think if you can get a good DST provider or have a good relationship with a broker that can get you into one for what I think is a good affordable price, I think they're great. I love them for the passive aspect of it.
Well, what about, because here's my beef with them, because like on paper I love them, but you alluded to it, like, I mean, the fee load on those, are high single digits, sometimes they're double digits.
Yes.
Like the fee load is crazy on some of those, which is just like, it's hard to overcome that. And I've had clients over the years say 1031's failing, they go to DST.
Mm-hmm.
And then, you know, I've looked at myself in the past, but I run the numbers with like the high fee load, which again, I don't like fees, but hey, real estate, especially alternative investments, real estate, we have fees in there, but they usually, you know, I want to always minimize fees is always one of my theories. But then it's like, well, sometimes if I just like pay the taxes on there and invest in the stock market, assuming the stock market's going to be 10% historic, you know, law of averages on there versus high fees and a 5% DST return. I'm like, on my spreadsheet, I come out ahead if I pay the taxes, invest in the stock market or something better, than getting the tax advantages and getting a lower rate return. I think some people get so focused on, I just got to save taxes. And I think people get tunnel vision on that. I'm like, yes, tax efficiency and deferring taxes is very important, but it's not the only thing to look at. I think some people get so focused on, I just have to pay taxes, they don't actually look into how is that investment's really going to perform in the long run.
Yeah, I would totally agree with that. I think one thing you're saying is don't let the tax tail wag the dog. Like sometimes,
better way to say it, yes.
Yeah, sometimes the best investment is to sell now, pay the tax, and move into a better investment. And for me, that's when it becomes the opportunity cost, which is what you're doing, is that analysis.
Yes.
Like, what is the cost to get into the next best alternative? You know, I do think, you know, again, it depends, right? You know, so it depends on how many capital gains have been maybe 1031 through, you know, 1 decade versus 4 decades of life or something. Maybe that's the determining factor. But at the same point, yeah, it would just have to be, I think, an independent analysis.
Yeah.
I think some people would be willing to pay for that just to be 100% passive and get the cash flow, just like, you know, I guess the monthly or quarterly check, whatever comes out, and then just to hold that till they die so their heirs get the stepped up basis. But, you know, there are some DST providers out there now that they're offering more of like a diversified portfolio of DSTs even.
Oh, really?
But they tend to be high fee too.
Yeah. Because I know DSTs, they have a lot of rules and regulations for what type of properties, how it's structured.
Yep.
I mean, and that's what makes it 1031 eligible. They're usually very low LTVs or sometimes paid off properties. But now that diversified DST, that's interesting.
Yeah.
On theory, but digging in, it's still not that exciting, it sounds like.
Well, yeah. I mean, you're still looking at a diversified portfolio of, I'll say, moderately performing assets, you know? So it's like, how excited do I get about, you know, something that gives me a 4 to 7% return?
Fair point.
Know? But again, that's where, you know, it so depends on what your option is. And so what I will tell people too is if you're holding a lowly, you know, performing property, maybe say they do an analysis, their return on equity is like 4% or something. Like, what's the cost of holding that versus selling and moving into something else?
Yeah.
And that's where I do love either the 1031 or just analyze it, pay the tax. And what I like about paying the tax is if it's manageable, then you're just increasing your tax basis a little bit at a time. So you don't quite fall into that trap of having to 1031 till you die.
Like 40 years of built up depreciation for capital gains.
Right.
Yeah.
So I think for some people it could make sense to just sell, have a clean break, and then go, into something else.
I'm going to change gears here a little bit. I want to just, this popped in my mind as we're talking about the stepped up basis and all that. Makes me think of like, people wanting to pass on their estate to their kids. And so when I started real estate, this is one of my interesting evolutions. When I started real estate, I was, hey, I'm going to buy these properties, hold them on forever, pay them off, let my kids inherit them.
Mm-hmm.
And then there was one day, I remember this day very vivid, this was years ago, I was sitting at a closing table, and some of the best deals we bought in single family, especially in like small multifamily,
Mm-hmm.
10, 15, 20 units on the table. A lot of times the best deals we bought were someone that inherited the property, whether it's the wife or the kids, and then 3, 5, 10 years later the property just run into the ground.
Yep.
And it hit me. I was like, oh great, we're getting great deals. And I was like, oh my gosh, the person that built this real estate portfolio passed away 5 or 10 years ago must be rolling over in their graves, because I'm sure they never imagined this was the outcome, where kids are fighting, the properties run horribly, and then also the property's on a fire sale.
Yeah.
And that changed my attitude. I was like, oh, that could be me one day, hopefully in 60 years, turn over my grave. Whereas like, I don't want that to be my kids. And I realized just because I want my kids to have it, real estate's a business. And if I'm passing down real estate, especially direct loan real estate, to kids who have no interest and they've not been, in the family business, so to speak, I think that's not an ideal solution and sets up a lot for failure.
Yeah, that is a really good point. And I have seen this with some of my clients that have maybe owned real estate for a longer time. One, there's this behavioral bias we all have called the endowment effect. And it just states that we prefer to own what we are, we prefer to keep what we already own. Yep. So if you think about like the house you live in, if it's not the house you would buy today, why don't you just sell it and buy the other house? It's like, well, we're already here. Our stuff's all in there. Our mess is here, whatever. We're used to it, right?
Yeah, we know the quirks of the house.
Yeah. Or if it's like a stock you've owned for 10 years and it's been terrible or, just mediocre even, but you won't sell it because you already own it, even though you wouldn't buy it again. So I think
it's called the endowment effect?
Yeah, it's the endowment effect. It's one of the reasons why people hold on to losing investments. Plus, the pain of acknowledging a loss is a lot worse than the gain of a good gain.
Yes.
So, it's like, dang it, I messed up, or I should have done something better. So that's why people hold on waiting for a bad stock to recover. And JP Morgan, maybe 10 years ago, they had a report that came out and showed that I think of the S&P 500, I think it was 40% of stocks have turned over since 1985, I think it was. So don't quote me on that.
In the 500
Yeah,
index?
within the S&P 500, 40% of stocks had fallen out.
Okay.
So not all of them went to zero, but they all lost that much market cap to at least fall out of the S&P. And if you're holding one of those and you're waiting for it to come back, it doesn't. And so, yeah, anyway, a lot of times stocks don't ever reattain their all-time highs, but yet people hold on hoping for it. So with that said, the real estate that we own directly that we might want our kids to inherit, I think that's such a warm, feel-good story, but I think it is very difficult because I've actually told clients this, you don't want to pigeonhole your kids into having to live out mom or dad's dream.
Mm-hmm.
You don't want to give them a job that they're not well prepared for and that they don't want, and that might actually, what you intend to be a blessing to them could actually end up just being a curse.
Yeah.
And I think too, there's this thought process like, well, we lived in it, we loved it. It was, maybe our first or second or third home or whatever. And our first, second, and third kids, they'll all live in there too. It's like, no, they're probably going to want a different house. And maybe they'll live in there temporarily. So what I view the real estate as is just kind of like I view money, and it's a means to the end, but it's not the end. So we shouldn't fall in love with our first property, or we shouldn't be afraid to 1031 or, sell or move up into a different property. It's kind of what that property can do for your life. I think that's the question that you should be asking. And there's an opportunity cost to that too, right? If you spend your time and put all your wealth into one property and you could have done better elsewhere, there's a real tangible cost to that, even though you never see it in your bank account. And that's probably by definition the opportunity cost.
That's a great point. A topic I want to make sure we talk about is how you have structured, that might be the word, structured your financial planning practice. Because aside from a lot of planners not understanding real estate, investing in general, which, hey, you got the subject matter expertise yourself on there yourself. The second is, I've talked to many financial planners, some coming on the podcast, just myself over the years, and they get, I'll call it AUM breath.
Mm-hmm.
Hey, assets under management. And a lot of financial planners say they take their 0.5 or 1% of total assets under management. Mm-hmm. And I feel like a lot of times their main goal is, they say, sell those rentals and invest in REITs. Well, first off, a rental and a REIT are not the same thing.
Right.
And second, I feel like you just want AUM. I call it AUM breath, right? Hey, they just want to get more AUM because that drives up their fees. And that creates a lot of times friction for real estate investors because they're like, real estate investors are usually very hands-on with their real estate investments. A lot of times they're stock investments as well, right? I can pick out index funds. I can read Bogleheads. Mm-hmm. And I've always found friction on there with financial experts, not just, with the lack of knowledge, but just with like alignment of how the business is set up. Can you talk about how you structured yours differently than the vast majority of planners out there and kind of talk about how the financial planning industry works?
Yeah. So there's definitely a lot there. I will say I think it comes down to conflicts of interest at the end of the day and just business models,
Business model, that's the word I was looking for.
Yeah, and so I chose to structure my firm as what's called a fee-only firm, which means that I don't sell any commission products. So I don't sell any investments. I don't sell any insurance. And so I'm only paid directly by my clients. And so that's one thing. So my bias and my belief is that by removing that conflict of interest of not getting a commission, then I'm able to give more independent, objective advice that's in my client's best interest as a fiduciary, which is what the standard I'm beholden to.
Yeah.
And so I just think that removing that conflict of interest for me is very personally important. Now, the pay structure, though, that's the other conflict. And we all have conflict of interest.
Oh, absolutely.
And I believe, my conflict of interest is to get paid and to make money, right? And so there's no perfect fee structure. But I think coming from the financial independence community, it tends to be very anti-AUM for a lot of those reasons you just mentioned. I think it's even harder when you're a real estate investor because, the exact conflict of interest, right? If you have $1 million in real estate and you're working with an advisor that's, charging a 1% AUM, that's $10,000 a year that advisor's not making, right? So after I transitioned out of the Army, through the VA, I connected with this mentorship program. And I was able to work with this financial advisor in another state, but he was an awesome guy, kind of mid-60s, winding down his career that just wanted to help mentor people. And like probably our second or third call, he's like, I got to be honest with you. He's like, I don't think being a flat fee advisor, which is what I am, where I charge a flat annual fee for the service. He's like, I don't think that's going to work well. And he's like, people don't want to pay dollars for advice. They're used to the AUM model. They're used to you just pulling the payment from their investment, so they never feel it hit their checkbook or their bank account, right? Which I think is also a conflict that we can pay so easily. Although after sending out invoices, I also get that's a significantly easier way to do that. But no perfect model, right? But what I explained to him and what we came to see over time was like flat fee is great for real estate. Because he told me too, he's like, real estate will be a horrible niche for you because they don't want to pay for advice. They want to buy real estate. And that's when I was like, I'll charge a flat fee and I'll actually advise them and help them with their real estate. And then over time, he's like, yeah, that's genius. Like no one's doing this. Now, in reality, I know a handful of people who do it, but we're a very, very small group of people.
Oh, you gotta be what, 0.001% or
probably
less than that of the financial planning industry.
Yeah.
Right?
When I say I know people, I know like,
Bob,
I know like
Sally, right?
Yeah. And it's like 8 other advisors who tend to love real estate and what it can do. And then, so it's just fun, because we can incorporate real estate into retirement planning. And then, whether it's early retirement or more traditional retirement, kind of like you were saying, or how does that mesh in with Social Security and then future RMDs or, Roth conversions and those levels of tax planning. Like that's where I think people need to have that real estate expertise. But so that's why, just to circle this back around, that's why I think fee only, my bias is that that's the best kind of business model because it delivers it with a little less different conflicts of interest, but less conflict of interest. And then the flat fee piece, I feel like I can advise my clients on all of their assets and even retirement plan assets. I've had clients come to me and they're like, well, will you also, talk to me about my 401k? Because my last advisor wouldn't, because he couldn't charge for it. I was like, that's crazy.
Really?
Yes.
I mean, that makes sense now that you say it, but.
Yeah. And there's actually a company, I'm not going to name the name, and I don't mean a company as a firm, but a product that some advisors can use to access 401ks. And once they have that, then they can charge an AUM fee on 401ks. It's kind of crazy. I'm like, why wouldn't you just tell them what to do? There's usually limited options. There's a few best ones. Just do that. But anyway, it's the industry. But yeah, so I think that if you want a holistic picture of your overall finances, and like whether it's the decision to move between stocks and real estate, or stocks, bonds, cash, real estate, crypto, whatever, I feel like a flat fee to get that advice, I think, is the most objective way to do that. Because then I've never put myself in the position where I'm like, this would be in your best interest, but if you do it, my income drops by X amount, right? So that's just been my bias. I think I've been heavily influenced by the financial independence community on that.
Well, that sounds like good things on there. I mean, I have a lot of the same
I think so.
philosophies, and I think I've had a lot of the same influences as well. So if people want to get in touch with you, because I know I have some real estate investors who are interested in your style of planning and that you actually know real estate, cornerstonefiplanning.com is your website, right?
Yep.
Okay.
And I would say that is the best way to check me out. I'm actually in the process of updating my website a little bit. So if they were to look too soon, maybe it'd be a little different a week later. But yeah, so Cornerstone Financial Independence Planning is what the FI stands for in the middle. And they can schedule an appointment through there or just shoot me an email.
Okay, and that's just Dan at cornerstonefiplanning.com as well.
Yep.
And we'll put these links to the show notes, or anyone can always email me and we'll make a quick introduction as well.
I appreciate that, Chris. Thank you.
Well, I appreciate everything we've done. It's been fun debates, and I think we have a lot of synergistic ideas and ways to help clients. What I kind of wrap up on here is looking forward, right? A little crystal ball time. We're sitting in 2025.
Yep.
Next 5 or 10 years, what's kind of like your macro outlook on stocks, on real estate, where the opportunities are, just from a very high level, like macro? Like, I'm a big trend. I always try, in my mind, I call it the BFT, the big freaking trend. Like, hey, what's the big trend? If I can ride that big trend, like the Denver growth wave, for example, Denver real estate growth wave in the last market cycle, it's a lot easier to get really good returns if you just ride the big trend. So that's my philosophy, obviously not yours, but like, what do you see from a macro next 5 or 10 years? What are you looking for? What are you bullish on?
Man, that's a really, really big, good question.
Sounds like not bonds.
Yeah.
From earlier.
Almost never bonds. I would say, again, there's no way to ever guarantee the future performance of anything, right? So this is not an attempt to do that at all. But when I talk about factor investing, historically that has gone in waves. It has ebbed and flowed. There's been times where growth has beat value and values beat growth. We've been in a long period of time where growth has beat value.
Yes.
I don't know, and again, I cannot guarantee it all. I think that might be reversing. I don't know. I do think that while the stock market, is currently down quite a bit this year so far, that's actually a good thing for expected future returns for current investments, because when the cyclically adjusted price to earnings ratio, or CAPE ratio as it's been called, very similar to a PE ratio, price to earnings ratio, if people are familiar, typically when that drops, future returns look better. So until this happened, we had been in a pretty mediocre looking 5 to 10 year outlook for stocks.
Yes.
So I think it's looking a little bit better now, even though it's very painful to go through at the time, especially if you're retired. And this is when, if you are retired, I really hope you are diversified, and there can be more of a definite reason for bonds or some of those other lower return, maybe less volatile assets, like we were talking about earlier. So yeah, I think perhaps we could be going into a different regime of where different factors perform better than what they have the past 10 to 15 years as we've ridden that growth wave. Real estate wise, I feel like I don't know. And I look at real estate all over. So I I invest in, I think, 5 or 6 different states if you include syndications.
Mm-hmm.
And so I kind of follow the markets where I have tangible real property in a little bit closer. And it's also different. You know, one market I've invested in is Austin, Texas. Another one is small town, Ohio. Completely different. And so when you talk about the law of averages, I feel like everything I look at is kind of in a blender for me because it's Colorado, those states, and then the markets that my clients are in. And so I kind of pay attention to those. I don't know that I have any one particular, trend, but this is where I will say I do believe that if you are going to do well in real estate, you kind of have, and stock market, any investing really, you've got to be in the game when a movement happens.
Yeah.
So for the people who are, like sticking their toes in the water, trying to time it, I think that's probably one of the more dangerous places to be because it'll almost always go up and then you'll almost always regret having now waited and paid and now have to invest in too high. It's another one of those biases that we all have. And so it just might take people longer to get started. So I think prudently get into each market based on the market cycle we're in right now, the interest rate environment we're in. We'll see. But there's a lot of unknowns, right?
Yeah, I was curious on your opinion on there because I got serious about real estate investing about 10 years ago.
Okay.
I've done a little bit before and then got kind of full-time focused around 2014, 2015 timeframe. And honestly, I caught part of the 2008 crash and recovery, but I was always like, well, hey, when the crash happens again, I'm going to be ready to just, pivot quickly in terms of like my investing.
Yep.
Because I saw so much wealth creation from that 2008, recovery for people that bought then and just didn't really matter what you bought. You just bought it and the trend went up and to the right and they made a lot of money.
Yep.
And so I've always been very focused, hey, when the market shifts, I'm going to shift with the market. I learned the market does not care about my opinion.
Yeah.
I learned that a few times. I can yell and scream all I want, say, hey, market, these still work. The market does not give a damn about me. I cannot move the market, unfortunately.
Yep.
And I had always envisioned, I was like, oh, well, a 2008 crash will happen again, right? Hey, residential prices will go up, residential prices will crash. And I was very wrong in that initial like crystal ball bet, I will say.
Yeah.
Obviously, like, real estate prices, especially here in Colorado, have not really dropped. I mean, condos have had some pain, but single families and, residential multifamily have performed pretty well. Even condos, hey, went up a bunch, dropped 10%. In the macro, you're still very good as long as you buy the last couple of years. But that's when I was like, oh, all the pain's in commercial. And I think what I shift on my philosophy is I have shifted a lot of my own personal portfolio, selling rentals, paying a lot of taxes the last couple of years, and then getting into, I think, better performing assets.
Yep.
And I think there's going to be, based on not just the market conditions, but I think a lot of these landlords that bought 2008, 2010, I think they're tired. Where, and I say tired just because, hey, they started out with, hey, they were $25,000, $50,000, now they're multimillionaires. Hey, them doing sweat equity or swinging the hammer for save $20 an hour,
right. Not worth it.
A lot big difference now when you're worth $5 million versus when you're worth negative $50,000 net worth, right?
Yeah.
And especially with insurance up, legislation becoming more compliantly difficult for a lot of markets, especially here in Colorado, I think there's going to be a lot of shifts of residential investments more to like commercial. That's people scaling up into like small buildings, 1 to 5 million buildings themselves, or more like syndications and passive funds. That's kind of like my big call for in real estate. I have no idea about stocks. Anytime I try to do anything in an index fund on stocks, I usually don't make money. But in real estate, I that's kind of where I'm placing my bet.
Yeah, I think that could make a lot of sense.
I'll tell you in 10 years.
Yeah, we'll have an update. Yeah, no, I think there's definite opportunities. And I do think, like you said, a lot of people jumped in way too excited to real estate. And I think now, I know I've seen it, online. There's people upside down. There's people having to sell. There's people who hate being a landlord. It kind of creates opportunities for some of us who are able to be buyers if we're in a position to. But yeah, I just think that's where it matters so much on to how you get in. Yeah. One of the coaching programs I'm in for commercial real estate, they always say buy right, manage right, finance right. And I love how simple that is, but yet people tend to buy high. They tend to mismanage it, and then they they tend to have to sell it or do something, some type of exit, refi. And refis are not so good still.
Yeah, they're tough right now.
Yeah.
And you're right. I mean, one of my, as I learned this now, but first thing on, hey, just buy right. And I was like, oh, you got to buy right. You also have to manage it right.
Yep.
And that was one of my, on the second or third orders of learning when it came to real estate. Like, oh, the management, the asset management, the property management.
Oh, yeah.
Man, that's what really matters on the asset.
Yep.
And that was one of my big learning curves, a couple years of getting to real estate. It's like, oh, this is the game here.
Yeah. No, I've been learning that too about the manage right. It's hard to be a long distance.
Are your rentals here in Colorado?
I have one rental in Colorado, a multi-family building with 11 units in Ohio, and then another single family in Austin.
Okay.
And I am involved in the management of all of them from here with a property manager in Ohio. But it's...
You still have to manage the property manager though,
yeah,
right?
Yeah. And then, yeah, because of how I bought it, just not to get into this, it's too long. But I still text tenants and, communicate with them. And I'm looking to get very much more passive in that. But having to build my team there. So at some point might be more vertically integrated, and then that might be a channel to expand there. So that's kind of where I'm playing the long game. But
what market in Ohio?
It's a little small town north of Columbus.
Okay, like Columbus, MSA?
No, not quite. I'd say it's a little further north than that.
Okay.
But they have seen a lot of growth as people have sold in Columbus and then moved north to have maybe a bigger yard, bigger house, more space, small town feel.
Yeah.
So there's been some growth there, but it's very much a small little blue collar town.
Yeah. Cool.
But yeah.
Well, Daniel, this has been fun.
Yeah.
I could talk shop with you a lot more. I think we'll, rather than try and do a 5-hour Joe Rogan marathon podcast, we'll maybe do a couple ones in the future this year. But this has been an absolute blast, man. So thank you for driving from the Springs today. Thank you for some of the debates. I got some books I'm going to read now as well. And like I said, we met, 7 or 8 months ago at BPCon or sometimes last year. And we've swapped stories. We've talked more detail. If anyone out there is looking for a financial planner that understands real estate investing, I would definitely recommend go out there and talk to Daniel. I would put him an option to go out there and talk. Great philosophies and actually knows real estate investing. So thank you so much for coming up today.
Well, thanks for having me, Chris. I really appreciate it. And just to be clear too, so Chris and I do not financially endorse each other or solicit or pay each other for referrals. So yeah, no, I have appreciated you as well, and you've definitely helped me out with what you guys do here. So yeah, thank you. Thanks for having me. It's a pleasure.
My pleasure. We'll be back on sometime in the near future.
Sounds great, man.
All right. Bye, everyone.
Bye.